right, welcome to this next series of our Multifamily Investor Nation weekly webinars. Today, we're going to be talking about how to get started in apartment syndication with little to no experience, really kind of no experience at all. And that's how I got started in this business. And so I want to break down a few ways that you can get started in this business as well. So we're going to be talking about this. We're going through 3 ways that you can get started with no experience, how to use other people's money in this business to be able to get started, and how to work full-time and still get started. So we're going to dive into some of these topics here, and then I'll open it up at the end for some questions and answers for those of you who are joining us live on the webinar. And so also, before I get started, before I dive into this, I wanted to talk to you about 2 things. So if you want to find out more information about me, I'm Dan Handford. I'm one of the managing partners of a group called PassiveInvesting.com. And you can go to our website, PassiveInvesting.com, and the Meet the Team section, there's a bio there about me, as well as our other managing partners and the rest of our team. We have about 15 people now on our team, and you can find out more information about each one of us on the website there. And if you want to join us on some of our future acquisitions for multifamily or even self-storage, you can actually fill out the form on the top right-hand corner of every page. There's a button. It's actually a blue button. You can fill that out, or you can click the button, and then the form that it'll bring you to, you can fill that out. Some of our investor relations team will reach out to you and schedule a phone call, discuss your investment goals, and make sure that we're a right fit for you. And then for those of you who haven't heard about it yet, we have an online virtual event happening June 10th, 11th, and 12th. So just a few weeks away now, and you can go there and register. Go to mfinsummit.com. You can register for your tickets. So go there, MFIN Summit. There'll be over 50 speakers, about 800 to 900 attendees at this event. So go do it now. If for some reason you go to the event and you're watching this video and it's past the June 10th, 11th, or 12th, that's okay. You can still go to the website. You'll be able to see the next event that's scheduled. It'll be in January 2021. And then, of course, every year we're doing 2 of these. So you'll be able to see which is the next event that is actually coming up for the MFIN Summit. So with all that said, let's go ahead and dive into the material today and talk about this, how to get started in apartment syndication with no experience. What I also want you to do is, as we're going throughout, if you have some questions, go ahead and write those down. And if I don't answer those questions with the rest of the material, go ahead and type them into the chat box. And that way we can have some good interaction at the end of the video. I guess at the end of the webinar, if you will. All right, so what are these 3 ways that you can get started with no experience? So the first way is to get started by participating as an LP, as a limited partner or a passive investor with a group that is already experienced, right? And that's one way to get started, right? So there's one way to do it, right? So you're actually putting up some of your own money to be able to participate in a deal. And so you're acting as a passive investor, right? And so that's one way that you can actually do it. The other thing that you can also do is you can act as a kind of co-GP, if you will. And as a co-GP, what you're trying to do is you're trying to go alongside another more experienced group and learn the ropes of actually how to run an apartment syndication business, right? Because you have no experience at all. And that'll allow you to be able to come alongside them. You'll earn a seat at the GP table, and you'll be able to build your credibility and build your track record, not only with the brokers and the sellers, but also with your future investors, because investors want to make sure that they're investing with somebody that has experience. And so if you've never put together a deal before, the hardest thing that you're going to find is that one of the hardest things you're going to see is that trying to raise money for your very first deal when you have 0 experience is going to be a little bit more challenging. So to be able to build that track record before you put together your own deal by yourself, you should actually go out and maybe put 2, 3, or 4 deals together with somebody else and play a smaller role as you're building that track record and as you're building your credibility. Yes, that could be bringing some money to the table from an LP perspective, or raising capital from some of your network of investors, but then also participating in some of the asset management duties, participating in some of the risk management or the risk money. Then also maybe signing on the loan. So now you're building loan or lender experience as well, whether it be with Fannie Mae or Freddie Mac, or maybe even another kind of institutional or bridge lender that you can kind of build your credibility and build your experience with. Because in order to sign on these loans as a syndicator or as a sponsor, you have to have a certain amount of net worth and liquidity, but you also have to have experience. So if you have net worth and you have liquidity, but you don't have experience, you're going to still have to go find somebody else to join your group in order to maintain or be able to meet that requirement, right? And so those are kind of the first two. Is first off is become a passive investor in a group. I recommend doing it the first way, and that's what I did, right? The first thing I did was I actually was an LP. I was a passive investor first in a few deals. Then I started to actually do co-GPs with other people. Now, the third way is similar or can kind of lead to the co-GP model, and this is what I did. Is I actually hired a mentor. Right. So here at MFIN, we don't have a mentoring program or paid coaching program or anything like that. And so I recommend that you go and find somebody that actually is doing paid coaching and go hire them. And that's what I did. Right. I hired a coach. I hired a mentor. They helped me be able to build my credibility for myself, but also build my confidence in what I was actually trying to do. And so I was able to talk the language a little bit better, speak a little bit more confidently and competently. And so I was actually able to get my very first deal awarded to me. Now, the reason why I said the co-GP option is similar to hiring your own mentor is that you can actually hire a mentor and they could potentially help you in a co-GP, right? So when you're interviewing other mentors about hiring them, maybe you might want to ask them, or do you have opportunities for me to be able to co-GP with you or maybe other members of your group that will allow me to be able to build up my credibility, my experience? And that's something that you want to be able to ask when you're interviewing those people, because some groups offer that. And some groups say you're on your own. You got to do your own networking. You got to be able to do that yourself, right? They don't do a lot of connections. But if you can find a group that wants to connect their members together and for them to be able to do deals, then that can be a win-win for you and allow you to be able to close your very first deal with no experience at all, right? Now, one of the things I wanted to break down with you today about using other people's money is that, yes, with syndication, you can find a deal, raise money, and from other people and not put any money of your own into a deal, right? Zero of your own money into a deal, and you can still put together a deal. Now, is that going to allow you to attract the most investors? Probably not. You're going to probably want to put some skin in the game, right? At some level, the investors want to see that you're putting money into the deal and aligning your interest with their interest, right? And so as the deal moves forward, when you make decisions about the actual performance of the asset, your own money is at risk as well. And so you want to make sure that if you can participate with your own money, that you do. Right. And in the beginning, it doesn't matter what the level of it is, right? Just make sure that you're participating on some level and you have a significant amount of money that you can say is at risk because you actually have it alongside the investors in that particular deal. Now, when using other people's money, I'm going to give you a little bit of a kind of background knowledge about my thoughts of raising money from other people, right? Because it's a really important concept that I want to make sure that you fully understand. And so what I'm going to do is I'm going to share my screen here with my whiteboard, and I want to do a quick illustration for you so that you can actually see this, and it'll hopefully allow you to be able to have a better understanding as to kind of our philosophy here at MFIN as well as passiveinvesting.com about how we actually try to attract investors to our project, to our programs here. So let me go ahead and get my marker here so you guys can see that. That's good. Let me undo that. All right. So what I want you to do right now as we go through this little exercise is I want you to go ahead and get out a piece of paper and let's go through this together. Okay. So on your piece of paper, get a piece of paper and a pen, pencil, marker, whatever it is. And I want you to do this with me because you'll have a better understanding as to what I'm trying to explain here. So first thing I want you to do is write a really large triangle on your piece of paper, just like this. Okay. Now I'm doing this with my trackpad, if you will, on the laptop. So these lines or whatever might not be as perfect as you can make, but in the middle of this triangle, I want you to write the words investor triad. Okay. So this is what we call the investor triad. And you can see I'm not really drawing very well here, but investor triad. Okay. So we're going to talk about these three things that are at the point of each one of these, at the point of this triangle, right? So at the top of this triangle, I want you to write the word know. Okay. K-N-O-W. No, at the bottom left, I want you to write here the word like. See if I can get this with this trackpad mouse. You can see I'm not really doing too well here. Know, like, and trust. I'm really actually excited about a new smart board that we just got for the studio here, which hopefully in the next couple of weeks or so we'll have something like that set up so we can actually start using it. But this is the triad, right? This is the investor triad: know, like, and trust. So for those of you who are joining us right now, of these three things, know, like, and trust, in order to attract the most capital from investors, which one of these three things do you think is the most important? So go ahead and type into the chat box there and let me know. Tell me exactly of these three things. Just put know, like, or trust, whichever one. And I'm not going to mention any names, so don't be shy. Just type it in there. Let me know what you think. Is it know, like, or trust? So this is the investor triad. I got lots of people answering here. Got know, all of them, trust, all, trust. Anybody else? Trust, all of them, trust. So most of you, when you first see this, you're doing exactly what I would expect you to do. You would think that trust is the most important of these three things. Now, I would challenge your thoughts on this and challenge your mindset on this, that even though trust is important, it's not the number one thing. The number one thing of all three of these is the word know. And the reason why know is the most important is because you have to be able to get to a point of getting people to know you and know who you are in order for them to make an opinion as to whether or not they like or trust you, right? So if you try to work so hard on getting people to like you and trust you, but you're not doing anything to get them to getting more and more people to know you, then guess what? You're not going to be able to find enough investors. You got to be able to get people to know who you are and then put a process in place that will allow you to get them to actually like you and then to eventually trust you. Now, one of the things that you'll notice here is that obviously you can draw an arrow from know to like, right? That's the first step in the process, is getting somebody to know you first, and number two, to like you. Usually within a matter of seconds, somebody knows whether or not they like you or not. Like all of you on here already have an opinion as to whether or not you like me, right? But I can't worry about those people that don't like me, right? I'm not really worried about those people. All I'm trying to do is be me, be real, and get more and more people to know who I am. And that way they can get to the point of making an opinion as to whether or not they like me. And then once they like me, that's when they start to get to the point of building that likeness to a point of trusting you, right? But you got to get more and more people to actually know you. All right. Now, once they know you, they like you, or they hopefully like you. And if they don't, they move on. But you build that point, build it to the point where they actually like you. And then once they start to follow you more, they get to the point of actually trusting you. And once they have that trust built up enough and they feel comfortable wiring you $100,000, $200,000, $300,000 for your next offering, now you know you've built that level of trust to a point where they actually trust you. And then what's really cool here is once you actually build up this level of trust actually goes back to know. And you might be thinking, well, how does that happen? If they already know me, how can they go from trust to know? That, my friend, is referrals. And that is actually where the gold is when you have built the trust enough with your investors that they trust you enough that they're now going to recommend and put their own kind of reputation on the line for you to make a recommendation to some other family member, friend, colleague. And this is really kind of where those referrals come into place. I'm just going to put a big old R here and put a circle around it. That's the referrals. And then what else is really cool about this is whenever you actually go and have these referrals come in, they go from trust to know, they don't have to go through this whole process again. They actually jump the likeness phase because they go straight to this trust phase. And the reason why they do that is because they already have somebody that likes you and trusts you. So you immediately have that trust built up with that referral. I can't tell you how many times we've released an offering and somebody actually, referred a friend over in the middle of an offering and they invested in the deal. We never talked to them, never actually had a conversation, never met them in person, nothing. And they've invested money with us, wiring hundreds of thousands of dollars to us. And it's because the friend that invested with us is the one that they're relying on that credibility, that trust with, and they jump this step, and they really don't have to know who you are. They want to know that they trust the referral source, and that referral source has invested money, and they say, if that referral source has invested money, I trust them, and I want to invest money as well. And once you reach that phase of getting that referral network in place here, where you have that going from trust to know, and then going straight over from know to trust, that's when you know you've actually achieved a certain level of knowing and trusting to be able to get more and more investors. So I wanted to share that with you just so you can understand that in order to find investors and in order to be able to kind of bring through another deal to the table, you've got to be finding more investors. So there's two things, right? There's two things that you always have to be doing. You always have to be finding the next deal, and you always have to be finding the next investor. You've got to always constantly focus on both of those, and that's why you actually need that team in place, right? Now, another kind of thing I wanted to mention to you is about working full-time, right? Working full-time in this business, and as well as trying to get started in this business, okay? This is a business. This is an apartment syndication business that you're thinking about starting, and you need to truly treat it like a business. I would highly recommend you not to treat this as a hobby. Don't treat this as, I'm going to do this after work. I'm going to do this on the nights and the weekends, because you're talking about people's hard-earned money, and it could be millions and millions of dollars that people are entrusting you with. And I recommend that you don't try to do this full-time. I mean, you don't try to do this until you are full-time in this business, right? Now, I'm talking about being the main operator on a deal. Now, that doesn't mean you can't go co-partner or co-GP or do a JV partnership with somebody while you are still working and you're building that track record, you're building that credibility before you jump out on your own, right? But you want to make sure that you are full-time before you try to take that a deal on your own. That's just my opinion, right? I think that that's the way the case should be, because I personally invest money in other opportunities, and I will never invest in a deal unless I know the main operator is full-time in the business. It's a big red flag for me, because I know what this business takes, and I know it needs full-time eyes and full-time efforts on it. So now you ask yourself, well, how do I get started? If I'm working a full-time W-2 job, how do I get started and do this? That goes back to that first almost 3 different ways to get started. You should first passively invest to get your credibility and track record, set up from that standpoint, to let the people know, hey, I'm actually investing in these assets as well. It helps when you talk to investors to let them know that you are already invested in these types of opportunities. And then co-GP with somebody else who is a main operator that can build your track record, build your experience, and you can help to build your investor base while you are actually working your W-2, and also raise money for those deals, participate in some of the risk money, do some of the asset management, maybe the underwriting, some of the due diligence, do something else that can help build your track record and your credibility, but but don't be the full-time operator until you've built up a track record and a credibility where you can successfully do this out on your own. I see too many people in this space that over the years have gotten started, they put together one deal, and that's it. You never hear from them again. And it's not because they made so much money on the one deal. It's because this is truly not a walk in the park. This is not easy, right? This is something that's going to be challenging. It's going to kick you in the butt, but you can get through it and you can do it. But you have to make sure that you have the proper resources in place and that you're putting full-time resources or full-time efforts in this business. So I know I probably discouraged some of you with that statement, but I just tell you like it is. And that's what I believe. And so that's what I have to share with you is to let you know that if you're not full-time in this business, don't try to be the main operator. Make sure that you actually have a main operator that you're partnering with that can actually do this stuff for you instead of just trying to work full-time in both businesses, right? Because one of them are going to fail. It's either your full-time a job is going to fail, or this is going to fail. And I would hate to see either one of those fail, right? And I also would for sure hate to see this fail, because you have lots of money from investors on the line, and it could be really detrimental to you. Well, let me go ahead and open up the table here. And for those of you who have questions that have joined us live, go ahead and type into the chat box. Let me know questions you have. We'll spend about 5 or 10 minutes answering some of these questions as you're typing them in. And then we'll wrap it up here in about 5 or 10 minutes. So somebody was asking, is this being recorded? Yes, it is being recorded, and we will send out the recording and post it on our YouTube channel so that you can watch it again if you would like, or if maybe you showed up a little bit late, you can certainly do that as well. So well, I don't see any questions coming in, which is perfectly fine. That means I must have covered everything very good. So that's actually good. Good. Oh, actually, I got a few questions coming in now. So let's see. How do you hold money from investors until closing? So it's usually held in some form of an escrow account, right? Whether that's the property bank account, or sometimes you'll put it with the title company and put it in their accounts. That money is held up in an account until closing. So a great question there. We don't usually put it out into an investment or anything like that. It's usually held up inside of the accounts until we actually close on the deal. If you do not invest any money in the deal, what amount of equity could be acceptable? Well, it depends on how you structure it, okay? Because Alex, you could set this thing up so that you have a JV partnership where you're bringing no money together at all, and you only have a few partners, and maybe they're going to give you 20, 30% of sweat equity, right, to be able to be the person who's the main operator and doing most of the work, right? And then of course, when you're talking about doing a syndication where you're bringing on, say, 20, 30, 40, 300 investors, however many it is, then there's going to usually be some form of an equity split. 70% to the LPs, the limited partners, 30% to the general partners, which would be you, right? Putting the deal together. And you don't have to put any money up to get that 30%. That's your sweat equity. Now, what I'm talking about as far as putting money up on that situation would be putting up some money alongside the LPs. So as an LP, so you're now an LP and a GP in the actual deal itself. So look, we got a bunch of questions that come in here now. So let me see if I can get all these things in here. Finding deals to analyze is difficult. Yes, it is difficult. It's not a walk in the park. But one of the biggest things I would say is you got to build a reputation with multifamily brokers in markets that you want to buy, right? And then also getting really good, if you want to go after some of the smaller assets, getting really good about analyzing the data on LoopNet as well as the county websites to be able to see who might be potentially ready to sell. How do you vet a sponsor to invest in as an LP? So as an LP, there are several different things. That's not really the topic of this particular webinar, but I tell you what I'll do is I'm going to find an article for you, which is on our website, that will help you kind of see some of the red flags that you should be asking a sponsor. So my wife and I put together these kind of 7 red flags of passive investments. And so let me type this article link into it. But for those of you who are watching the recording, you can go to passiveinvesting.com, go to the Knowledge Center, and in the search box for the Knowledge Center, you can type in red flags, and this article will show up for you. But for those of you who are joining us live, I'll go ahead and just type this into the chat box so that you can actually just click right onto this link, and you can actually read this article about some of these ways that you can kind of vet a sponsor for these deals. So let me see if we can see here. I want to know how to structure the deal and what depends on the structure of the deal. So, Tricia, that's a great question. We're not talking about the structure of the deal here, but if you go to our YouTube channel and type into the YouTube channel structuring or deal structure, whatever, some of those types of lingos. I know we've done a couple of webinars on that already, and we'll be doing some more in the future. So as long as you're connected with us, we'll make sure that we do some more details on that, because that's a long discussion. It's usually about a 45-minute webinar that we do on that, because we want to make sure we break down what a waterfall is and the hurdles and equity splits and preferred returns, preferred equity, mezz debt, all these different types of terms and terminologies and language and lingo so that you fully understand it. What are your thoughts of experience level needed before going to a 506C? I think with the 506C, it's people think it's like the holy grail, right? Because now you can actually market and you can advertise. But if you try to market and advertise and get people that don't know you to invest and you have zero track record and credibility, it's going to be more challenging, right? And so for me, what we did is we started off by doing all 506 Bravo. And if you don't know what I'm talking about and what he's asking about as far as the 506B and 506C, go to the YouTube channel and type in securities or 506B or C, and you can find more information about the differences and the nuances between a 506B offering and a 506C offering. But with these different offerings, there's different levels of things that you can and cannot do. And with the 506C, you can advertise, right? But if you advertise for a bunch of, cold investors, if you will, but you have zero track record and credibility, they're going to be a little bit of a harder time getting them to want to pony up and invest. But if you have a really large list of people that you want to market to that already know who you are, they already have credibility, then the 506C might be a good way for you to actually get started and get going. But most people start with the 506 Bravo. And I know a lot of people that still just do a 506 Bravo and that's it. Our group has actually moved away from that. We might do a 506 Bravo once a year, but most of our offerings are going to be 506 Charlies from this point moving forward. All right, let's see here. How do you find groups to be a passive investor? So great question. Again, we're not going to go into a lot of detail with this, but meetup groups, RIA events, Facebook groups, going to conferences, events, and networking with other people, getting in front of business executives and business groups that actually, that might be high net worth individuals that have the ability to make money. But a lot of it is just getting out there, doing some grassroots networking with other people. Make sure that you have a pitch deck ready. I think we actually did one on this topic recently about raising capital for these types of investments. So if you go to the YouTube channel, you type in raising capital, you'll find a couple of videos there that we've already done on raising capital. So I'd highly encourage you to do that. Let's see. I got a lot of questions in here. I'm not going to be able to get to all these questions. I'll take maybe one or two of these questions and then and see what else. See where we go. So what if you want to co-GP but aren't able to provide a strong personal guarantee? That's okay, right? So there's lots of different roles and responsibilities when you're co-GPing. You don't necessarily have to be a personal guarantee, right? You can be more of a behind the scenes type person. So most lenders, unless you own 20% or more, are going to require you if you're on. Are not going to require you to be on the loan, and so in most situations, you're not going to really qualify for that anyway, especially as you're building your credibility and your track record. Because most of the time, as you're getting started, all you care about is having a seat, a small seat at the table. Depending on the size of the deal, it might be 5% or less, or it might be upwards to maybe 15, 20%, depending on what you're doing, right? So you want to make sure that you kind of negotiate that and figure out what is the best opportunity or best kind of percentage for you. But if you have zero credibility, zero experience, 1% is enough, right? Because you're on the GP, you're getting that credibility, you're getting that track record. You can jump on the asset management calls and you can start to build your relationships and be able to build that credibility, right? That track record and your experience to be able to take down more deals. Let's see. So John, and this is the last question I'll take. I know a lot of you still had some questions. I apologize we're not able to get to it today. But if you have some more questions for me, feel free to bring them to the next webinar. We're glad to be able to answer some of them there as well. What is the best interest percentage to give investors? It really depends on your investors, right? So right now, I'll tell you what our investors expect, and you can kind of see how you guys put things together as well. So for our investors, they're going to want to see a kind of preferred return, cash on cash of around 7 to 9%. I'd probably say 6 on the low end. So 6 to 9%. Right now, getting up to 8 or 9% is a little bit more challenging, but usually around that kind of 6 to 7, 7.5% is where most investors are looking at right now because of how hot the market is. On an overall or annualized return perspective, they're looking at 12 to 13% on the low end, upwards to 15 to 20%, right? Just depends on the deal and the risk profile. Because every deal, whether it be an A-class property, B-class, or C-class, it's kind of a different risk profile. And the higher the risk, the higher the return. So going after a C-class property is actually a higher risk investment. And so those usually have a higher reward. The opposite of that, going after a stabilized Class A asset, is going to have a lower risk type of an investment, and so it's going to have lower returns. So you're going to have to kind of hedge that depending on where you are and what type of assets you're actually putting together. Well, thank you so much for participating today on the webinar. Let me see if I can refresh the screen here and see what the next webinar is going to be next week. Next week, we're going to have Brandon Abbott, one of our other managing partners, here with you. He is going to be talking about, can you run a multifamily syndication business as a side hustle? So he's going to talk to you a little bit further about this and talk to you about how you can actually run this, or if you can run this as a side hustle. So make sure you go to multifamilyinvestornation.com/MFIN webinar in order to register for this next event. So it's coming up next week. We'll also send out an email. So if for some reason you didn't catch that URL, that's perfectly fine. We'll send out an email, circulate it around so that you can go ahead and register for the next event. So thank you so much. And if you haven't done it yet, make sure you go to mfinsummit.com and register for the next MFIN Summit coming up on June 10th, 11th, and 12th. We'll look forward to seeing you back here next week.